Hello, chart watchers, and welcome to this Monday, March 26th Market Watchers Live Show with your hosts, Tom Boley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, after all the selling we saw last week, we're getting a little bit of a reprieve this morning. Dow Jones Industrial Average up 333 points, the S&P 500 up 28, the NASDAQ up 84 points, and the Russell 2000 up 12. While all are up, they are off of their earlier highs. We'll take a look at some of those intraday charts and long-term charts in just a few minutes. The 10-year Treasury yield opened up earlier today, but it is now down to 2.83%. Volatility continues to remain high. It is up at the 23 level. That suggests that we could see wild swings at any point during the day. The XLK, which is the technology ETF, having a nice day after trailing the market. This has actually been the worst performer over the last week, but it is up 1.5% today. The XLF, the financials, up about 50 cents almost, close to 2%. This is actually the leader today. Industrials having a nice day, up over 1%, and the consumer discretionary, the XLY, also up more than 1%. Those are the four aggressive areas of the market, and they are leading today, which is good news. Software index bouncing back nicely. You can see remaining well above the February lows. That seems to be what we're looking at on a lot of these indices. Are we holding those lows or are we not? You can see software performing very well. Defense stocks actually making a nice little breakout of a bullish wedge today, and it is not that far away from its high that it set in late February. So on a relative basis, defense stocks holding up very well. And with that, let me bring in my co-host, Aaron. How was your weekend? And happy Monday.
Well, happy Monday to you. Looking forward to some good Monday setups. Well, actually, they're not so great, I don't think. It's been really tough, hasn't it, in the market? I had a great weekend, though, but thanks for asking.
Yeah, well, right now the market's very difficult. I've said before, for me, when the volatility index is up here like this, the moves can be very substantial in both directions. We saw both Thursday and Friday huge sell-offs in the last couple of hours. And then today we wake up to great news, or at least great futures, with China saying that they're willing to come back, or come to the negotiating table and talk through some of the differences, some of the trade differences. And I think that, may have buoyed some of the indices a little bit this morning, but you can see it's still a struggle to move higher from the open. So I don't know. It's a difficult market. And as I said on Friday, it's really, to me, what happens in the last couple hours of the day. And Friday was not good. Thursday was not good. And we still have this afternoon to go to see whether or not we can hold on to these gains. So I don't know. Pretty tough market to trade. I would agree with you.
Oh, yeah. Just the volatility is, like you said, it's just been crazy right now. And yeah, the idea of a Monday setup and getting into the market right now is a little bit, I don't know. It's not so tasty right now. There's not a lot to bite, in my opinion, but we'll talk about what we can find and what is good. So
there's a bunch of stocks, ETFs out there that could potentially produce some really nice gains. The problem is you got to take extraordinary risk to go after it. And that's the problem I have. In February, there were 2 weeks, my Monday blog, Trading Places. Every Monday I provide a trade setup, and then I also provide additional setups. And twice in February, I wouldn't do it because I just felt like the risks were too great. And I did the same thing this morning. I just back off when I see the VIX up in the 20s and 30s because you just don't know if you're going to be up 300, 500, or whether you're going to be down 700. And I find the risks are too great. So I like to see things settle down a bit and try to get a gauge on which way I think the market's going to go. And right now, to be honest, I'm not sure where it's going to. I don't know where it's going to be at 2 o'clock this afternoon.
Well, if we knew that, we wouldn't be sitting here having this show if we knew what the market was actually going to do.
Yeah, trading. I would be trading. But anyway, we got a lot to talk about, so I'll let you get through the schedule and the agenda for today.
All right. Well, we have everything stock charts coming up tomorrow. We'll see some interesting new tips or tricks, maybe a reminder of some things we can do. Mark Young from Wall Street Sentiment Survey is going to be here on Wednesday to talk, and Arthur Hill, our resident blogger and expert, will be here Thursday to talk with us, and Friday There is no Market Watchers live show, but the market is closed. So you won't be missing anything if we're not here. So with that, let's look at today's schedule and what we will be doing. And we will start off with Monday setups right after the technical news, followed by an earnings spotlight. And I believe John is in here. John Hopkins is here for that particular segment.
Actually, he won't be in today.
Oh, he won't be in today. Well, we'll miss him, but I know you'll take care of that just fine. So, and with the next one we have will be the 10 and 10 to 1. And our first symbol is going to be Lowe's, LOW. So if you want to go check that out. And then finally, we'll finish with the DecisionPoint report. Certainly some interesting information that I will be bringing to your attention for that. But for now, let's go ahead and move on over back to you, Tom, for some technical news.
All right, let's start with the Treasury market. Here is the 10-year Treasury yield. You can see it is down slightly today. It did gap up a little bit at the open, but we have been moving lower since. I could pull up a 10-minute 5-day chart here, and I think it'll show up a little easier, a little clearer. But here was the gap up. You can see we actually had cleared the last couple of days' highs, but ever since the open, we've been moving mostly lower again today. And of course, that means money is moving into the bond market, which is a little bit more defensive. So I like to see this kind of movement to the upside, or continuing, day after day moves to the upside. I don't like these gap ups and then failures, which just tells me it's maybe, I don't know, encouraging some folks to jump into equities and then kind of pulling the carpet out from under them. We'll see whether or not that's the case later this afternoon. But the 10-year Treasury yield is moving lower today, and I find that to be short-term bearish, although we do still remain in that longer-term trading range from 280 on the downside. We tested that on Thursday, and 295 on the upside. We got very close to that back on Tuesday. So not only have we seen a lot of volatility in the equity market, but we're also seeing it in the bond market as well, with the markets trying to figure out which way we're going to go. We continue to consolidate in both, but that the range has been pretty wild of late. And I expect we could see that continue, especially as long as the volatility index remains where it is right now. Speaking of the volatility index, let's pull up the VIX. And here you can see the breakout that we saw on Thursday. That's what made me very nervous at the end of the day, clearing that prior candle body high. And then Friday, we continued to move up, reached up to 26.27 on the high. We have pulled back a little bit today, but we still remain elevated. I think anytime the VIX is up in the 20s, you have to be really careful. Normally what that does for me is simply just sends me to the sidelines. I would rather let the market settle down. I don't want to be trying to make emotional decisions in the market. And I think that's what you get a lot of times when you have a volatility index in the area where it is right now. Now, there's a lot of things we could talk about and be bearish. I do think that the banks, Greg Schnell had a great article. I think it might have been a Don't Ignore This Chart article toward the end of last week, talking about how many of the banks are breaking down. And you got to sit back and at least scratch your head and wonder why, what's going on with the banks, and why are we seeing such poor relative performance of late? Maybe because they'd made such a nice move. It's just a little bit more of this consolidation. But from where the banks go from here, I think is going to be pretty important. So let's pull up the bank index here, and you can see the 2 days last week. This index lost 7.5% roughly in just the last 2 days of last week, Thursday and Friday. That was a big move. Not only was it down, but it also violated that early February support level. And if you go all the way back here to the move when we made the breakout above the late October, early November high back in late November, the reaction low that we saw was back at about 465, and that's where we held in early February. Well, we closed at 455 at the end of last week, bouncing up nicely a couple percent today, but really unable to sustain the move to the upside. We opened at 462 and change, where it's 464 right now. So I think the banks still have a lot of work to do. In the short term, if we can continue to strengthen, I think eventually we're going to run into some serious overhead resistance at that declining 20-day EMA. So that'll be worth watching. But I'm not overly bearish. I'm still short-term cautious for sure, but I'm not overly bearish intermediate to long-term. And I'll tell you a couple of reasons why. I mean, if you've been watching the program, there are a few things that I like to follow underneath the surface, rather than just get caught up in the Dow being down 500 or S&P, breaching certain support levels. I like to look at what's going on when the market rallies. And so if you take a look, for instance, at the XLK versus the S&P, I'll go ahead and pull that up, but I want to move to a weekly chart. And I also like to use, when I use relative charts, I like to use solid lines. I think candlesticks just really make it messy and hard to see what, that the long-term picture is. And then here on the bottom, instead of the RSI, really what I want to do is look at how it's comparing, how that ratio is comparing to the S&P 500 itself, and change the height. And actually in this, I don't even care about the moving averages on that relative chart. Okay, let's go back. I'm going to go 10 years back, which takes us really back during the last bear market. And I want you to look at the XLK versus the S&P 500. It continues to rally along with the S&P to the upside. Yes, we've pulled back a little, but you can see the relative strength in the XLK remains. And this is one of the most aggressive areas of the market. So if we were truly heading into a bear market and the economy was going to slow, maybe even go into a recession, it would seem to me like everyone would bail out of technology. And that is not what we've been seeing. The same holds true for the other key aggressive sectors. Here's the industrials. Industrials continuing to perform pretty well on a relative basis following this move to the upside. Then we go to the consumer discretionary group, which had strengthened considerably at the end of 2017 and into 2018. And look at the relative breakout here. The group is continuing to outperform the S&P 500. And if we go to the financials, even though last week was really rough, when you look at the relative strength, right now financials, after breaking out to a 9 or 10-year high, are still holding up pretty well on a relative basis. So I look at this and I don't see, under the surface, I don't see big money rotating out of aggressive areas of the market into defensive. If we were truly going to be going down throughout the balance of 2018, I think money would rotate in much more bearish and conservative fashion, and that is not what we're seeing right now. Now, if the market were to rebound, if the S&P 500 were to turn back higher and break out again at some point, in the next few months or over the summer, and you don't see these relative ratios rising with it, that would be cause for concern. But I'm just not seeing it there at this point. So I'm going to remain fairly bullish on the market overall, but I'm trying to pick my spots as far as entry. I don't want to jump in to a market where we could see the Dow down another 500 or 700 points this afternoon. And again, that's when I see the VIX in the 20s, it's telling me that the market environment is such that I can see those kinds of drops. And I don't really want to be establishing positions ahead of something like that. So I'm just going to, it's just my personal style, but I would rather see things start to settle down a little bit. Federal Express, or FDX, I should say, which is FedEx, actually came out this morning and announced that they had reserved 20 Tesla semi-trucks. I thought I had seen that news once before, so I don't know if this is a repeat of the news or if this is new news. Maybe it was UPS, but for some reason I'm remembering Tesla had 20 of its trucks reserved, and I thought it was FedEx. But anyway, I saw the news coming across. We did get a little bit of a gap up in FedEx today. I wanted to bring this chart up, though, because look at what happened on this false breakout. I remember talking about FedEx that day, how delivery services were looking good. FedEx had come out with their earnings and it looked like they were breaking out. Well, they didn't break out. They actually came back down and had a false breakout and left that long tail. And if you recall back to Friday when I talked about reasons to sell, there was a perfect example on FedEx of why you sell when you see that kind of a reversal. Look at what FedEx did the next 2 days after that. Came all the way back down. Now we're coming back down, maybe testing the February low. I would be looking for some kind of reversing candle before I would be too excited about FedEx. Lowe's, their chairman and CEO, Robert Niblock, announced he's retiring. Lowe's is searching for a successor. And how is this to let you know what a great job you did on your retirement? Lowe's is up 5.6% today upon Mr. Niblock's announcement that he's retiring. Can't feel too good about the job you did when the stock moves higher off of your announcement that you're retiring. But I do think technically Lowe's, I don't like this candle right now. This could be another example of what we just saw with FedEx. We get that long tail up above the 20-day and we come back down and we fail to hold it, close below the 20-day. It could be a short-term problem for lows. One positive here, though, lower lows on lows, and a higher PPO. So we do have a positive divergence here. If we can close above the 20, I think we have a shot to run up to the 50. But if we fail and leave that tail up there with the kind of volume we're going to see today, that could be troublesome here in the near term for lows. One other, well, actually, two things I wanted to mention. I'm going to turn it over to Aaron, but I'll try to do this really quickly. First is under the market summary. I don't know if you noticed. I know earlier, let me see if it's still the same. Under the international ETFs, and you take a look and we see green everywhere. Look at what's red today. The Russia ETF, the RSX. The White House confirmed earlier that it ordered the expulsion of dozens of Russian intelligence officers from the U.S. and the closure of the Russian consulate in Seattle due to its proximity to one of its submarine bases and also to Boeing. And as a result, you can see the Russia ETF is the only international ETF shown here on this list that is lower today. I thought that was kind of interesting. And then the last thing I wanted to just mention is the XLE. When we look at the XLE, how it's been just kind of going sideways here for a while off a downtrend, it's in a little bit of a bear flag. That is kind of interesting when we take a look at what crude oil is doing. Check out crude oil trying to make a breakout above the late January, early February high. There's typically a pretty strong positive correlation between the direction of the XLE and the direction of crude oil. But we have seen throughout March a complete negative divergence developing with crude oil prices surging while the XLE is going nowhere on its chart. So this is something to keep in mind. With that, I'll turn it over to Aaron for some upgrades. Actually, I don't think we have any downgrades, but we do have a few upgrades we'll share with you.
Yep, absolutely. Let me get you my screen here. All right, we have 5 upgrades that we're going to look at, and like you were saying, no downgrades. Oh, are we going to have screen sharing problems? Of course we will. There we go.
You got it.
Okay, I got it. All right, so here are the 5 upgrades I'm going to look at. I did a few annotations, so I'll just go through them very quickly for you. I found some really interesting chart patterns and just the setups in general for these. So Dollar Tree, you know, when I look at the scooter and I'm looking at a PMO that's in oversold territory, it's getting ready to go up, I get kind of excited about it being a good thing. But I'm looking at this chart pattern and there is some serious overhead resistance here. It just can't seem to get itself above that. And even if it were, I think there's still a lot of overhead resistance to look at past there. So while I think this one has a pretty good setup as far as the indicators, I really need to see some confirmations just straight out of the price action because I just don't see that just yet. Darden Restaurants would be the other one to look at. It's now hit some pretty important support here, and it does look like it's going to bounce off of that. And I think you have a pretty nice setup here to get all the way up here before you hit around 91, before you hit some overhead resistance. Of course, the PMO is ugly. The scooter is pretty ugly. The OBV is pretty ugly. But, you know, we fell off a cliff here last week. So I would still be giving this one the eye, maybe put that in a watch list and watch and see if we can get some better momentum going on the PMO. But support does appear to have been found, and this is a pretty strong area, I would say, of support. Intel we have in the technology space. So the PMO just had a sell signal, so that's not anything I'd be excited about, of course, but you can see we're still seeing a lot of relative strength and internal strength when you look at a scooter that is sitting above 95. You've got a nicely moving OBV as far as the angle of ascent. We're seeing an ascent and not a descent. And we have what I would say is a bullish chart pattern here. The descending wedge, the falling wedge, is a bullish chart pattern, and we can see, if you look in there, that we're getting a bounce off of this area where we saw the last 2 tops in January and late February. So I think there's some potential here. Of course, we're already at almost a 3 3/4% rise. Watch that declining tops trend line, and let's see if we can't get that breakout. This is a little bit of a concern, but you can already see that PMO is trying to decelerate and turn up higher. Altria Group. So let me make this a little bigger so we can see everything. All right, so we lost some pretty important support here, but if you want to go down here to, the drop we saw back in July and use that as your support area, you could do that about 58.50 or 59 where it's sitting right now. We're in that oversold territory as far as the PMO, which I like, but it still hasn't started to decelerate. And, it popped down below this area of support pretty quickly and easily. And you've got a very negative configuration of EMAs right now with your fastest, the 5-day EMA on the bottom, and price is trading beneath that 5-day EMA. So we're seeing some very strong downside pressure here on Altria Group. So I'm not liking this, even though we just got the upgrade. I would watch these. Sometimes the upgrades aren't as great as they seem. Now this one I thought was pretty interesting, Marathon Oil. And, right now, according to my DP indicators, and you can see it right here with the PMO on a buy signal and curving up out of oversold territory, and that move in the scooter to get above the 75 mark. So while that all looks good, and I am bullish on USO right now, I'll be talking about that more in the DecisionPoint report. This is a little concerning. Now, you don't have a head and shoulders until you actually end up with that right shoulder and a breakdown. So this is not this isn't a head and shoulders just yet, but you can see how it could be a possible setup for one, especially when you get up to this previous price top and then immediately turn back down. However, if you look in the thumbnail, you can see a flagpole and possibly a pennant on the side of that. So watch for a breakout above this area at 1650. If we get that, I think we're going to head back up there for oil and for Marathon Oil as well. And that is it for the upgrades and downgrades. And with that, I'm going to get my charts here for the Monday setups and let everybody know what I have selected.
Yeah, I think we'll have first, we'll take a look at the what we had last week.
Oh, that is true. Yes.
Because I think you snapped my winning streak, unless I haven't looked in the last 15 minutes, but unless I had a miraculous recovery, I think that, you did better than me this week.
Yeah, let's go take a look at those charts, actually. Let me get over here. So first one, I'm going to show mine because I still have it set up from last week. So yeah, I had it in at 109.45, I think. And we have that sending triangle. This is a bullish formation. I was really looking for that breakout. We'd already poked out above.
You need to look at your charts now.
Thank you.
No problem.
I forget we transferred that back over. All right, let's see.
Yeah, I think on RL, of course, you were at 109.45 last week, and you were at 109.93. So you actually have one that went up, and I can promise you there haven't been too many that have gone up. I do, a lot of the retailers in the clothing and accessories, I noticed on my strong earnings chart list, those did tend to weather the storm much better than a lot of the areas of the market. But you actually went up about 0.5%. Over the last week, which was a great trade, especially on a relative basis.
Well, I appreciate that. Thank you. Yeah, I would have liked to have seen it done more. And I'll tell you right up front, look at the PMO. I really like that false, that what we call a bear or a bull kiss. In this case, I would call it a bull kiss because we came down, kissed the line, and we're now getting ready to head up. I actually still like Ralph Lauren, and I almost was going to make this my pick again for this week because I still think we're going to get that breakout above that 110 area, and I still have a target way up there at 120. So I think this still looks pretty good. I might tighten my stop up now that the market is a little bit volatile and a little worrisome. I might move that up to 105, but that's not my pick. And then you had, which one was it?
It was GWRE.
That's right.
So, and this is one actually I had owned, and I talked about this, I think, on either Thursday or Friday. I think it was on Friday when the market was, after we'd had that big down day on Thursday. But I ended up getting stopped out or just closing positions in a lot of different stocks. And actually, Guidewire software was actually one that I got stopped out on Thursday. And I think the rest of them I had sold either on Thursday afternoon or early on Friday.
Yeah, and it did. It didn't. It wasn't able to hold that support level, and looks like Thursday was a good day to get out because Friday was pretty bad.
Yeah, it actually had bounced. If we go back, I think it was on Monday of last week, it actually did print a hammer right on the 20-day moving average and went up for a couple of days. It was looking pretty strong, but then, of course, the overall market tanked, volatility shot up. And like I've said before, that the problem I have with trading, especially based on technicals, is when you get this high volatility reading, a lot of times your technical support levels, you go through like hot knife through butter. They
Right.
just, they just don't hold the way you would expect them to hold, which is why I tend to just stay the heck out of the market when the volatility is so high.
Oh, yeah, I totally am with you there. I end up hanging in a lot of times in these volatile markets just because I do hold a lot of my positions more intermediate term. But it's always a good idea if you want to just turn off your investments, is what I call it. Just move to cash. You can always get back in. But I haven't really pulled back that much off of my intermediate term investments just yet. So I'm not in the bear market camp of that we are in one just yet. I still think we're just looking at a correction, but I could be proved wrong later. We'll see. So those were our Monday setups from before. These are the ones I actually wanted to look. Remember, last week was the first time I did shorts because I was feeling negative about the market, and turned out to be a good call as far as the negativity. But EQT, it did go down from Monday. I don't think it was as good of a drop as the other one. JCI fell out of the sky. So this turned out to be a really nice short because I picked it up on the Monday setup back here when it dropped below this reverse flag. So yeah, this one really did head down for the basement, and it doesn't look like it's quite ready to stop that. But if I'm correct, and I looked at that as a candlestick, I think it might be turning into a hammer. And I know those are bullish, so we'll have to see. But that was interesting to see that happen. But let me go into what our actual picks are for this week. So I'm going to start over here, as some of you may have read ahead. Let me get this big. All right, so these are the ones that came up on my scan. I did have to end up, I really did manipulate them a lot this week. So the one I think I ended up going with, and that's why I saved it here, is similar to the one that I have printed and linked in the Market Watchers Live blog. Only it took some of the characteristics out. You don't have to have 20, I think, above the 50. I think that was what I changed on that one. And I think I let scooters be whatever they happen to be at the time. So I came up with very few. And so from there, I just sort of, pulled and changed some other scans and looked in. And this is, I ended up with actually a lot of bond funds. I ended up moving here. So here we go. Let's see. Foxy is what I look at that. Foxy, FXY, Japanese Yen Trust. Nice rising trend channel here. I've got the PMO is a little bit on the overbought side, and I don't really like that it's trending lower. But we are on our way to a buy signal, and you can see a nice scooter move. And look at the accumulation here on the last couple moves. Very nice. So I would consider this one, and I think if you look at it quickly on a weekly chart, you can see that there is still some upside potential here. This is the area right now. It seems to be hitting some resistance at that 92.50 area, but there's certainly a great chance to get up here and test this overhead resistance back here at about $97. So I thought that one was interesting. The other one is Midas Gold Corp. Another nice rising trend channel here. And look at the PMO, really nice cup here on it, just kind of coming up here, and it's just now getting ready to have a buy signal. Typically, you can see with this particular stock, you end up with not very noisy signals, and they usually tend to have a lot of good potential here. So I like the way that's set up, and you can see OBV is really behind this move. At this point, of course, this is a very low volume, and of course, we're in the penny stock range here. So typically, I wouldn't be bopping in there, especially in a very volatile market. But I'm just showing you some of the ones that came up on my scan, and that one I actually pulled in. This is another one, a low price stock. And again, I think it's just a matter of the market just doesn't have a whole lot of upside potential right now. I don't think in a lot of these areas. Bonds, I think we're looking pretty good. Anyway, we've hit this overhead resistance here at about 5.25, but we're getting ready to have a nice PMO buy signal. Scooter looks good. OBV is trending higher. But again, you're talking about some volatility here when you're in a low-priced stock as this one is, or ETF. So the one I ended up picking, though, is a government inflation protected bond fund ETF. One of the ones I also usually look at is the TIPS, TIPS. This one I went with because I think the setup's pretty good. We're in an uncertain market. Bonds are looking more bullish. We have a PMO buy signal that has just occurred today. You've got the breakout of a ascending triangle here. I'm liking the way this is set up, so I'm going to be going with WIP at 59.15 with a hope of a target at about $60 here. As far as the stop, you know, I would probably go around this 58.50 area, but probably watch and see where this rising bottoms trend line goes. But for the Monday setup, I'm gonna be looking for a target of around 60.
All right. So
yeah, but you can see it was pretty much a lot of junk out there as far as my scan, and that generally tells me to stay out. So I really had to manipulate today. I really had to give myself reasons to find stocks to get into, and that tells you there's a problem right there.
All right, I will take it over and see what I've come up with here. First of all, as I said earlier, I did not put anything in my blog today because I'm not trading right now, and so I'm not going to provide trade setups if I'm not trading. So keep that in mind. I'm not working off of my strong earnings chart list, even though I do think that there are some pretty interesting stocks on that list right now, and I'm going to go over some of those in the earnings spotlight in a few minutes. So I think what I'm going to do today for the setups is, and I guess we need clarification, Aaron, because I'm going to be on vacation next week. So is this going to be a 2-week contest, or are we just going to do it as of a week and I just won't be here?
Yep, I think we'll just do it as of a week. We'll keep track, and we won't saddle you with whatever Greg picks like we did last time.
Yeah, please. I mean, I love Greg, but he saddled me with a big loser last time, so I'm not trusting him again.
Yeah, we'll keep that one on his plate. So you won't have to take credit. Well, you won't get to take credit if it turns out to be good either. So
that's fine. That's fine. Like I said earlier, I thought he had a great post last week on the banks. But anyway, let me get going into this here. So what I looked at, and if I was going to trade, one of the things that I would be looking at is areas of the market where we're at some pretty significant support. And I think the biotechs are one space where we had a negative divergence. You can see the higher prices here. This is a weekly chart, by the way. So we had higher prices, big breakout, but then right here you can see that the PPO, the weekly PPO, was much lower. And so that negative divergence, a lot of times what I look for, you can see those pink arrows, I look for a 50-period test and a center line test. We're almost to the center line. We've already tested the 50-period. And you can see from this green box here over the last 5 or 6 months, this 1900 to 1950 area has been really solid, rock solid support on the biotechs. So I started with this idea that the biotechs were in a key support area. And then I went to the mid-cap stocks in general, the S&P 400 mid-cap. And I noticed that going back over the last couple of years, this is a group that is pretty close to a trend line support. And the breakout occurred at about 1780 or so. We've got a 50-week moving average just above 1,800, and you can see the trend line came up around 1,850. So the mid-caps had hit 2,000, and I think this 1,780 to about 1,850 area is a really a key support area on the mid-caps. So from there, what I did is I looked at mid-cap biotechs, and I'm not going to go through. I'll just show you how I quickly went into that. If you go into the scooters and go to mid-caps and then type in biotech, you will see a list of all of the mid-cap biotechs right here, and I've got them in scooter order. And essentially, I looked from about the 40 level up. I know, biotechs have been weak of late, so I thought maybe there might be some good ones in the 40s. I don't know that I would go below that. But 40s up all the way to the 90s, upper 90s, and these are the ones I came up with. First, my pick was ALNY. So this is the one I'm going with. ALNY, you can see right now, actually, it's breaking below the 20. I'd like to see it hold the 20 today. It's currently at 135.57. So that is going to be the price to be used for next Monday. We'll see where it is. I would love to see a pullback below the 20-day moving average and maybe a close back up above or near the 20-day. Maybe similar to this pullback here where we got this hammer back in October. And then we're able to bounce off of that. That would be something that might interest me. You can see a lot of tops coming across here, about 137.5 to 140. So on the pullback, if we can leave a tail down below and come back up and move above, I think we could be setting a bottom on ALNY. So I'm going to stick with this one as my pick. I'll go through a couple of others that I thought looked interesting as well. GNMX. This one looks to be breaking it back up and out of a sideways consolidation off of an uptrend, so I like that. Only 56,000 shares have traded today, though, so it's not a huge volume stock. Keep that in mind. ADVM, I actually owned this one recently. I still continue to like it. Sideways consolidation off the uptrend, 6 to 650. Seems like a pretty good support zone here. ARWR. This one has come back down to a price support, so if we annotate and draw that line going across right there, that is on this high. Here was the breakout, big volume. You can see we're right down at price support right now. So I think the price support and the rising 50-day moving average should provide some pretty good support, and hopefully buyers will emerge from here. Just a couple more. PTI. Pull this one up. PTI, you can see had a huge move up. Look at the volume coming in on this. These 3 days right here on the huge gap up. We've pulled back from 8.5 now back into the 4s. And you might think when you gap up from $4 and you move all the way to 8 that you'll never go back and fill the gap. Well, here we are about 6, 7 trading days later, and we're almost ready to fill that gap. I think that the reward to risk is starting to look much nicer on this one as it pulls back. But you can see the huge volatility. This is a stock you want to be real careful about. If I was in it, it would be small position sizes because of the huge volatility. You want to be careful that you don't, overcommit yourself to one risky stock. Let's take a look at SRNE. This is Sorrento Therapeutics. Lots of support coming across here between 6.5 and 7. That's where we're currently sitting, so I think that looks interesting. And the last one I have is QGEN. Now, this one only had a scooter of 43, and you can see on a relative basis it's not looking as good as some of the other charts, sideways consolidating for a while. But I looked at the weekly chart, and I thought the weekly chart off of an uptrend showed a lot of consolidation, with 35 being a key resistance level and 30.5 to 31 support. So if we see a little pullback here, I think QGEN closer to 31, you've got really a solid really solid reward to risk ratio there. So with that, that's what I have for this week. Let's give you a quick summary of the picks that we have made for this week. There's Aaron's WIP 59.15. I went with ALNY 135.57. And we will see a week from now, or everyone else will see. I'll probably forget about it because I'm going to be at Disney World. But hopefully, we'll see how things work out for next week, whether Erin can continue her winning ways.
We shall see. And somebody asked about the low volume on WIP. I can also say that a similar fund ETF would be TIP, similar setup. So if you actually are interested in trading those, that's another possibility. Personally, I'm out. I'm not buying anything right now. So
makes sense. Yeah. With this kind of a market, I think sometimes it's not a bad thing to just kind of sit and let the market settle down a little bit. But again, that's just my preference. There are a lot of traders who love the high volatility because you can make a lot of money in a quick, short period of time, but you got to get the direction right. I mean, it's really, and then if you don't get it right, your trades become very emotional. I mean, if you look back, if you're on the long side and you look back to Thursday afternoon or Friday afternoon, I mean, the market was just free falling with no support whatsoever. I look at those periods with high volatility and a sinking market as periods when market makers just go on vacation. That's what I always say. You know, they're there to provide liquidity, and they know with volatility rising that the market's getting very fearful, and they don't buy in those situations and let the market go, kind of like a matador lets a bull run by.
Yes. Yes.
Anyway, we do want to move on, though. We got earnings spotlight, and John Hopkins couldn't be with us today, but I do have a number of stocks that I would like to share with you that come from my strong earnings chart list. The first one, I don't know if I'm going to get the pronunciation here right, Caleris, but I can get the ticker symbol right. It's CAL. So CAL, I'm going to pull all of these up on my relative ratio chart that I like to use, and I'll go down to the bottom here again so you can take a look and see how I set this up. I get a lot of questions all the time. But essentially, these price windows down at the bottom here, you just go under indicators, select price from the drop down, and then here are the 4 settings I use. So I use dollar industry. So this will, for whatever symbol you put in, it's going to bring up the industry that symbol is part of. The next one I use is dollar symbol, dollar industry. So I can then see how the stock I'm looking at is performing against its peers. And then finally, or actually next to dollar symbol, dollar SPX. This tells me how the stock I'm looking at is performing against the benchmark, because that's what I'm trying to beat, is that benchmark index. So I typically want to try to move into a stock that is outperforming, maybe has pulled back on a relative basis recently, but still is strong technically. And then finally, the dollar industry, dollar SPX. So this tells you how the group that the stock belongs to is performing as a whole relative to the S&P 500. So each one of these that I go through, you'll see the stock price and the chart going back over the last year. You'll see the industry group. In this case, it's the apparel retailers, DJUSRA. And if the symbol comes across here and you don't know which one it is, you can simply type in that $ DJUSRA here. And when you do that, it'll tell you Dow Jones U.S. Apparel Retailers Index. So that's how you can kind of cheat and take a look at the industry group. So this tells you how, on an absolute basis, the apparel retailers is doing. Then you're looking at CAL relative to its peers. You can see that it's really strengthened here of late, and how it's doing relative to the S&P 500, nearing a breakout, very strong over the past few weeks. And then finally, how the apparel retailers are doing relative to the S&P 500. And I think we're just seeing sideways consolidation after this uptrend. I don't want to see this break to the downside. That would be bothersome. But recently, you can see it's moving higher, and this is what we were talking about earlier with Aaron's RL pick. I'm not sure if it's in, it might be in apparel retailers. It could be a clothing and accessory. See which one that is. Clothing and accessories, CF. So it too, the group overall bounced last week a little bit, especially late in the week, even though the market was going down. And as a result, you can see that the group on a relative basis clearly outperformed the S&P last week. And you can see here, RL is outperforming the S&P and not too far away from breaking out against its peers. So excellent pick there. But anyway, CAL was the first one. I'm going to go through a couple more. All of these stocks that I show you, they have beaten Wall Street estimates in their latest quarterly earnings report. They beat on the top line and they beat on the bottom line. PRTY, which is Party City, I think this is a specialty retailer. So it is has been a very strong performer. It is also in the space with Netflix and some of those other specialty retailers. That's why the group overall has been so strong, because obviously Netflix has been a great performer. But when you look here, you can see we're actually trying to break out above multi-month highs on PRTY, and this is coming with all the selling that we saw last week. So if you can get into the right group, sometimes even when the market sells off, the relative strength will carry you through. And in this case, PRTY continues to look really strong. A breakout above 16 would be very bullish. The gap up here you can see came on heavy volume. That was related to earnings. And since then, we have continued to see heavy volume, and it is not breaking down. It actually continues to strengthen. And I see off of this uptrend equal highs and rising lows. So I see an ascending triangle here that is also very bullish. IGT. This is International Game Technology. We did get a big breakout here above the prior high with earnings. This one, however, did get taken down with the selling that we saw last week. Went all the way back down. It even went below the bottom of gap support, which I was a little surprised. I thought we might hold there. But now I am looking at a major low down here at about 25.5. This is one of the stocks, if the market keeps weakening and I can get some kind of reversing candle where we actually maybe move a little bit below 25 intraday and come back up and close around 25.5, 26, it could signal a short-term bottom. So this is one that I've got on my radar. Not buying it yet. I don't like the fact that we keep moving lower. But if I get the signal that maybe we're seeing a reversal, that's when I'd be willing to take a chance on IGT. Here is your gambling index. Here's IGT relative to the gambling index. I think off of that low that we saw back in June, relative low in June, we have been putting in higher highs and higher lows throughout on a relative basis. So I think this is still a pretty good area within gambling stocks. The IGT relative to the S&P was weak here over the last week or so, maybe 7 or 8 trading days, but that came after breaking out relative to the S&P 500. So I think as long as these relative lows hold, I'm still okay with IGT. And then here is the gambling index, which just a week or so ago was up near or maybe even piercing to a new relative high versus the S&P 500. So I think it's a pretty strong group. So IGT is one that I've kind of got my radar on. Let's take a look at ANF. Here's another one of the apparel retailers. Very strong. Look at the gap up here with huge volume. Pulled back, tested that rising 20-day, and we're trying to actually make a breakout today on ANF. I'd like to see a little bit more volume on it, but still, relative to what's going on in the market, I think it's pretty clear. ANF's been very strong. Here is ANF relative to the apparel retailers. It's one of the strongest ones out there. ANF relative to the S&P 500. And again, you can see that the apparel retailers are strengthening relative to the S&P 500. So ANF, Abercrombie and Fitch looks very strong. And let's take a look at maybe one or two more. I have Ross Stores up here, but that's another one that's going to be in the same kind of area. So I'm going to switch to Keys, Keys. This is actually in, it's a technology stock. And again, if you go into DJUSAI, Electronic Equipment Index. But it has pulled back after moving up on very strong volume. It's pulled back and right now trying to hang on to this 20-day moving average. Normally when you get a strong, I'll come back to this relative chart in just a second, but normally when you get a strong push on the upside like this and the PPO, the daily PPO is going up with this high, many times you pull back to the rising 20 and you hold and then start to move up again. So that's what I would be looking for here ordinarily. But again, because of the high volatility index, I'm just not so sure that this area is going to hold. If the market sells off in panicked fashion again this afternoon, many of the stocks may lose some key support. So Keys, I think the 20-day, and I would actually say the low from Friday just below 51 is going to be a really important level to watch on a pullback. But volume trends are very strong here. So I think even if it sells off, if it does make it all the way back here to this double top breakout around 48 and it gets to that 50-day moving average, it could set up a great trade. But again, I just think for right now, it's probably worth just watching to see. So let's go back and look at that relative performance here. And you can see the overall group continues to do very well. Its peers, Keys relative to its peers broke out and looks very strong. Relative to the S&P, broke out, continues to look very strong. And on a relative basis, I would be looking maybe at these lows coming across. I think as long as the DJUSAI holds up on a relative basis and simply consolidates or continues to strengthen, either one of those scenarios, I'm fine with a stock like Keys. But let's see if the market can settle down a little bit first. And so that's it for the earnings spotlight. These are the stocks that I wanted to just alert you to let you know They are companies that recently did beat top and bottom line estimates on Wall Street. And I think technically look good, are part of groups that overall look pretty good. So it's really just waiting for the market to settle down. But those are the stocks that we took a look at today. And with that, it is time for the 10 in 10. I'm going to let Aaron take over and maybe show you the 10 in 10s on an RRG, whatever you have in store, Aaron.
Yes, well, thank you. We have a lot in store. We had a lot of requests today, 36, which is quite a bit. We usually average more like 24. So people are really excited to check things out. But I went ahead and I'm going to show you the RRG, but we're not going to really pay close attention to the actual diagram here because there are just too many stocks in there to make it readable. But here's what I found interesting was looking at the table for the RRG and seeing which ones were in the leading category, which ones were improving, etc., lagging. And notice that with the picks today, a lot of them are in the leading category. So we have a lot of, I guess, relatively speaking, stronger stocks in the request zone today. So let's go ahead and we'll start with the first one, though, that we told everyone about, and that would be Lowe's, L-O-W.
All right. Well, Lowe's, I talked about a little bit at the beginning of the show, so I'll just do it really quickly here. But they did make an announcement that their CEO and chairman, forget the guy's name, Niblock, that's who it was, Robert Niblock. He is retiring, and so maybe not great for his ego, but upon that announcement, you can see Lowe's has gapped up and is trading up about 5.3% right now. But it challenged a key area of short-term resistance, in my view, off of this gap down right here. I believe this was earnings related. They fell short or they lowered their guidance. I can't remember which, but they didn't come out with a great report. I know Home Depot's report was stronger. But Lowe's did gap down here. We rallied back to 90, but you can see that's as high as we got after that announcement, and we moved lower. Today's news sent us back up to challenge this area. I don't like this candle right now, leaving that long tail up there. If we close below the 20-day, I think short term we'll probably go back and revisit the bottom of gap support. But we are starting to get a turn in the PPO to the upside. So there is one positive that is starting to work this, toward or in Lowe's favor. And so if we did go back down, challenge that recent low with a positive divergence, if the volume on that move back down is much lesser, then I think we'll start to look for maybe a little bit more strength. Short term, on the other side, if we can finish strong today and break above 90 on the close, then I think we're setting up perhaps for a 50-day test. And maybe this breakdown of price support at around 95, that coincides with that 50-day test. So that would be the next level if we can close above 90.
All right. Let's see. Our most popular request, the one that got the most likes, and I always put that in as our second one. So that would be, imagine this, Apple.
Apple. Well, we're rebounding a little bit off of the lows that we saw and all the selling that we saw last week. The problem I have is that I think on Apple, it's going to run into some overhead resistance in the near term. That was a pretty key gap support that was lost on some pretty big volume at the end of last week. Notice the two tails going up Friday and again today, right at that 170 area. That's going to be the first test. We got to get back through 170. I know Facebook kind of fell apart when it fell below that level and hasn't been able to regain it. I know it was weak earlier. But Apple is one of the leaders today. It is up 2.3%, which is nice. But I think we've got to get back through that 170 level. The scary part here for me on Apple is I don't really see a whole lot of support until we get back down to challenge that February low. And if Apple goes back down there, it's hard to imagine the market overall doing that well.
Yep, I have to agree with you. All right, for our Canadian friends, first Quantum Minerals, FM.to.
All right, good news is we've hit support and we are bouncing. So I would be okay with it as long as it continues to hold the recent low right here. That is down at about the 17 level. Today's earlier low was 1708, and now we're back up at 18, so it is holding. You can see the two moving averages above, and also a key area of price resistance just above these moving averages. So I think you're in a trading range, 17 to the downside, just below 20 to the upside. And currently we're at 18, so maybe a little bit more room to the upside to go here. But that's the range that I would continue to watch.
Okay. Next one is Raytheon, RTN.
Yeah, it's in that much stronger defense area where we've been seeing on a relative basis very solid performance. And I think that, Raytheon is kind of following suit. I mean, doing exactly what I would expect it to do in this group. There was a negative divergence, although a lot of times I won't really follow these negative divergences when we get a 50-day test like this in between, but it was very short-lived. I still think it was good based on the lower PPO and the higher price. I think it was probably a good thing for Raytheon to sit back, and consolidate with its PPO getting close to that center line right there, and then also getting these 50-day tests. I think that was a good sign for Raytheon. We're now strengthening again and nearing what I think is some pretty solid overhead resistance around 220. But given the way the market's performed, it's hard to argue against Raytheon. It's been a great relative performer.
Okay, let's see. Next one is DRNA, and that would be Dicerna Pharmaceuticals.
All right. Well, I don't like the loss of these moving averages and trend line support. But, I mean, trend line is kind of so-so. Whenever you connect just a couple of points on a chart, then trend lines, are kind of, I'm not going to say they're useless, but they're certainly better if the more points you have connecting a trend line. I think they're much more substantial. So I really liked what happened on Friday with heavy volume, putting in that long tail, kind of a hammer hanging onto this support, this trend line support area. But we're down again today. I think today's going to be a pretty big day for DRNA because we are below the 50-day. You can see the PPO just making a bearish centerline cross. We did that back once in mid-December, and we're able to hold on to a price support level and then turn back to the upside. I think with the trend line here, we're going to need something very similar. So I would feel better about DRNA if it reverses later today and holds on to this trend line. The further it falls, and especially if the volume picks up later today, that could be more bearish. So I think today will be interesting for DRNA.
All righty. Another popular one that a lot of people want to see is Cisco. It's very interesting because it is sitting on some strong support there.
Yeah, I think price support and gap support are going to be the two interesting things to watch here on Cisco. But clearly, traders are feeling a lot better about Cisco on a relative basis. Many stocks, many parts of the market coming back down and challenging the early February lows, maybe even some cases breaking down below on a closing basis. Cisco's nowhere near. We're up 10% above those February lows. So I think on a relative basis, you got a pretty strong performer here with Cisco. So this is a stock that I would be comfortable holding on to. A loss of $42 on a closing basis would make me a little bit more nervous because then I think it would open up that February low. I don't see a whole lot of support until we get down to, at least the 40 area where we've got some gap support. You got another one?
Yes. Did you cover Facebook this morning? I don't recall, but there's still a lot of interest there.
Yeah, Facebook, I think, has got a lot of problems. I just do not like the chart. I said it last week, even with it bouncing back up intraday a couple of days ago. I think that it's lost some key levels. And on a relative, actually, that's what I should do. Let me show you the relative strength chart here on Facebook. Because I think this is probably the most important thing. The problem with Facebook is not only clearly have we lost some key support, which I would draw right around 170. I mentioned when I was talking about Apple, 170 was a level that Apple lost. Well, Facebook lost the same price, 170. and you can see since moving below. Look at it try to get back up above 170 and leave that tail up above and close below it. I think that set up more selling, which is what we've seen. We do have a long tail challenging this support area, which is the next support around 156 or so, maybe 157. So if we can hold this on the close, then I think maybe we go into this sideways consolidation. But do not ignore this volume. It is selling off on very heavy volume. I think there's a lot of distribution taking place in Facebook. I would not own it. And the other thing that I think is really important is looking at Facebook relative to its peers. The internet space isn't that bad, but when you look at Facebook, there was your relative high versus the internet space. Here was your relative high versus the S&P 500, and we are trending down on both. That bothers me. So Facebook, I do not like.
All righty. And the next one we have for you is ENPH. And that was, what was that one? Yes.
Enphase.
Energy.
Yeah, Enphase. This is one I actually owned for a while. I know it was one of my setups. It was doing really well. I haven't seen it in a while, though. Oh, yeah, it's continuing to do extremely well. I wish I had held on to this one. Wow. Yeah, I mean, it was like 2 when I think I bought it in the 1s. I think I got it somewhere down here.
Oh, my.
I think it was a setup right in here somewhere, and I was looking initially for a 20-day. Anyway, this thing has just been on fire. Look at the volume.
Nice.
Okay, now this is one of the times I look back and say, why don't I hold?
Yeah, and that's why I try not to look back, because that makes a lot of sense if I held it. Yeah,
but then there are a lot that go the other way. What I would say at this point is we got a clear breakout above about 3.25. Look at the volume coming in on this gap up and continuing move to the upside. As we keep moving up there, the PPO is rolling over. I think we're probably getting a little ahead of ourselves here with an RSI up at 80 and price support or gap support all the way back down at 3.25. I don't know if we go all the way back down there or not, but this one looks like it's getting a little ahead of itself. So I like the stock, but I would be probably ringing the register at this point.
Okay, let's see the next one. You know, there's always some interest in this one. GBTC, of course, the Bitcoin. I know we usually stay pretty far away from Bitcoin.
Yeah, to me, I mean, every once in a while you get things that are a fad, and I don't know if this is definitely going to end up being a fad or not. But you've got a lot of different markets around the world that aren't allowing trading or, somehow restricting trading in Bitcoin, and the volatility has been, unbelievable. I mean, we were at below 7.5. We went up to 38, got up close to 40. 3-4 days later, we're back down at 12.5, and next 2 days we're up at 25. And then, 6 weeks later, we're under 10. And so you can clearly see the volatility. You might look at it and say, well, it's just been sideways. Well, this is sideways between 10 and 20. This isn't sideways between 10 and 12. So tremendous amount of volatility. You can see that the PPO now is residing mostly in negative territory. That tells me that the momentum is mostly bearish on this. So I just have to see. For me, it's just too volatile. I wouldn't be interested anyway. But I'm just going to kind of circle that. That really bothers me for any kind of an asset to remain below the center line that long on a daily chart. I think that the odds are that it goes lower.
All right. And the final one is international ETF, the Egypt Index ETF, EGPT.
Looks pretty good to me. I like the bounce right off that 20-day moving average. We had a really strong move to the upside. So if we just kind of highlight here this move, and you take a look at the PPO at the most recent high, the PPO was also at its high, which means when it pulls back, I look for that rising 20-day moving average to provide support. And I think it clearly did that right here on the pullback. Whoops, that was not what I wanted. All right, I'm not sure what the heck happened there. Let me just do that again. Clearly it didn't like something I did. All right, so again, let's try that. Here is your uptrend. Here is that PPO that continued rising. And then in terms of a pullback, when I don't like to buy when it's going up and you've got RSI up in the 70s or 80s, but after you get a pullback, you can see that RSI dropped into the 50s and we were right on that 20-day moving average. That is normally a good time to enter, and it has bounced about a buck off of that earlier low. I would expect it to trade back up to that 38 and some change, 38 and a quarter area, at which time for me, if I was playing it off the 20-day, it would be a quick trade and I'd be out. But overall, I think it looks pretty strong here.
Yeah, I like that bounce. I think that's good to see. All right, well, that completes our 10 and 10 to 1. And here are the symbols that we did cover. And I think one of those you did the relative ratio chart on. So I will make sure that that goes in there and people can see how you set those up, because we always get questions about that. But these should be up shortly after the show. And for sure by this evening when I get the Market Watchers Live blog recap in. So go ahead and you can go look at that. Just go to the Market Watchers Live blog, and the link is at the top for the chart list in which all of these 10 and 10 stocks are. And with that, I think it's time to talk about something that's coming up in August. And that would be ChartCon is coming up in August. August 10th and 11th, we are going to have our big every 2-year convention. And the second time, we're going to do an online conference. So you don't have to travel to Seattle to come see us at ChartCon. You're going to be able to go and watch us live using the live stream, similar to what we're doing right now. And you'll get to keep that, all of these conversations and all of these presentations you're going to get to keep after the conference. And you can see we're doing it mostly on reducing risk. And I think you're going to really enjoy the lineup that we have. But if you really want to get into things, I highly recommend you consider joining us at ChartCon, and I'm going to show you the information on that, as a VIP. So you can actually come. We would love to have you. And if you just come for the ChartCon portion over the weekend, you can come sit up front and center. I know my new husband's actually going to be there sitting front and center. I'm really shocked that he really is excited to watch all of these presentations. But I imagine you guys would have a great time there. And then also, if you want to add in a summer vacation to your ChartCon experience, you could go on the cruise with us afterwards to Alaska. So that would be a great time as well. And really, when you're considering this is the cost for you and your significant other for a cruise and the ChartCon VIP experience, I think it's a pretty good deal. So anyway, are you getting pretty excited about ChartCon, Tom?
I am. I'm always excited. It's good to get together with all of our fellow analysts and not only catch up on the business side and what they're seeing with the market and so forth, but also catch up on the personal side, because a lot of great people. And I know some bring family with them. I imagine that there probably is going to be a lot more of that going on with it being a cruise, Alaskan cruise afterwards. So, yeah, I mean, I'm looking forward to seeing everybody. And I think from a viewer standpoint, the fact that it is about risk, I mean, we're now 9 years into a pretty solid bull market, a lot going on. Who knows what's going to transpire between now and August, but there's always a lot to cover, and there's always seems to be something going on that we have to consider in the market. So I think everyone providing their own information as far as how they deal with risk, I think will be a great topic for the entire
absolutely
the entire ChartCon. And I know that there is an early bird registration, and I don't know how long that lasts. So it says right now ends March 31st, I guess, for the.
Well, this is for the VIPs, yeah.
For the VIP, I don't know about the early bird registration to just be a part of ChartCon, but I know there are a couple reasons for the early bird. Number one is to give you a break on price for signing up early, but it also helps us in terms of getting a feel for how many people we might have. So it's really a good reason to sign up now. Make sure you reserve your spot.
There you go. Early bird pricing right here at $199. It will be going up soon. So consider this, get your place in there as far as the online conference is concerned. And seriously, $200 to get all of those presentations, and you get to keep them. So it's not as though you go to a conference, see everything, and then promptly go home and forget it. You actually get to keep all of these presentations and go back as you need to. So excellent deal. Highly recommend it. It's got to be, you must have gotten some money off of one of the stock picks here, stock charts here on Market Watchers Live, and there you go. You can use that to pay for your ChartCon experience. Anyway, I think we should get on with a, let's see, back here. Let's go ahead and get into a market update. And we're going to go ahead and start with the candle glance. These are 2-day charts, 10-minute bar charts that give you an idea of what's going on currently in the markets. As you can see, I mean, the market is still up, Tom. I mean, we still got that big gap up. And although we pulled back and took about half of those gains back, we've started to make our move back up to test some of these intraday highs on the Dow. You can see S&P 500 is now pausing, but it also looks like it might be interested in getting up here to test the high for the day. We also can see that the NASDAQ, you know, these big gap ups. In terms of the NASDAQ, though, it pulled back almost all the way back to the open or the close from yesterday. And so we're seeing that rebound right now and a little bit of pause. You can see with the Russell 2000, I'm not liking this double top that's formed intraday, but we're still on the positive side. Not nearly the gains that we saw this morning. See Wilshire 5000, same thing. Some of these are coming back, the Dow Industrials especially. You can see that Treasury yields are slightly higher right now, reading at 2.841, and UUP gap down, but does seem to be mostly consolidating here sideways. And you can see the opposite is true, of course, for gold, where we got the gap up. But now it started to round off, and now we seem to have hit some overhead resistance here at about 128.60, currently reading 128.43. USO is lower on the day. We can see that the VIX is down on the day, but we're still looking at readings above 22, currently reading at 22.59. So the volatility is out there. There's still a lot of fear going on in the markets, despite having that beautiful run up this morning for most of the major indexes. Let's go to our market summary and see what's going on with these sectors and industry groups, as well as our international ETFs. And I think you did take a peek at that earlier. Right now, financials and technology, consumer discretionary, all of the aggressive sectors in the market are doing very well. Add that in, actually, the industrial ETF as well. We're looking at gains above 1.5%. When you look at technology and financials, they are up currently over 2%. So we're getting a lot of those aggressive sectors doing well today on the rebound. Banks, computer, tech, we can see semis all in the top half of the industry indexes. Laggards, oil services, natural gas, airlines, commodities, those are the only industries right now reading in the negative. And we can see as far as our international ETFs go, India, South Korea, China at the top here, as well as Taiwan, all up over 2.5%, with the India ETF up almost 3% right now. Only laggard, as you noted earlier, Tom, the Russia ETF, which is currently down almost 0.75%. And let's go to our top movers right now and see what's going on in the S&P 500, our most active. Not a surprise to look at Facebook. We're getting a lot of interest there. It's the most active currently on the S&P 500. Percent up, Microsoft, Lowe's, as we were looking at, Intel, all leading, all up over 5% currently in the top 10. And with that, I'm going to conclude the market update. And feel free, Tom, if you saw any interesting charts that you'd like to let us know about, go for it. I'm going to get my DecisionPoint report ready.
Yeah, why don't you go ahead and get that ready? I'll take the screen from you for a second. I just wanted to share, I'm not impressed by today's rally just yet. I mean, it's always nice to see the Dow Jones up 400 points, but we have to keep it in context and look at some of the counter trend rallies that we've seen in the past. And so here on my chart, I have an S&P 500 chart, which is just a 1 hour chart. So it's an intraday chart. It goes back to the end of January. So it's a 2-month, 60-minute chart. And when we saw the selling that kicked in back in late January, early February, we had rallies. I mean, you can see here off the huge selling that we saw over a 2 or 3 day period back in early February. We did rally, went just above the 20-hour moving average and then right back down again. And then in middle of February, we rallied back above the 20-hour and we held it and continued to trend up off of it. So I think that's going to be the really first test as we look at what we've seen here over the past 2 weeks. You can see that off a negative divergence, we had a slightly higher high back in, I guess it was March 12th. We had the PPO rollover, so we had a negative divergence on that high. And since then, you can see that the PPO has continued falling. Every time we've hit a new low, the PPO has fallen to a new low as well. We're starting to get a little bit of a move back up on the PPO, but I'd have to see another low so that in order for us to have a positive divergence. So if we move down one more time, I think the S&P 500 could find some support around 2540, 2550. But that's another 80, 85 points away from where we are right now. And I'm not seeing, we haven't really been able to sustain a move through that declining 20-hour EMA. And right now we're sitting at 26.27 and the 20 hours at 26.45. So it's nice that we're bouncing back off of it, just like it was nice that we bounced back in the first week of February. But the question is, can we get through that 20-hour and sustain it? That's the first step to starting to repair some of the technical damage. With that, I'll let you get back and take over with DecisionPoint.
Absolutely. Now, it's interesting, if you have read the DP weekly wrap, let's see if I can get this to share properly. The DP weekly wrap is in the blogs section. I will go ahead and show you quickly how to get to it. But Carl writes this on Fridays, the end of the week, and gives us a really good outlook on what happened and what we should expect in the future. So I'm leading you right there to the weekly wrap. Let me go through a few of what the charts that he has put on here, but I'm going to go through mine after, because I want to give you my slant on the market. Carl now is of the opinion that we are now heading down into a bear market. And one of the reasons he's saying this is where we finally got after 16 months of a buy signal for the DP intermediate term trend model, 16 months, that failed finally. And we got a 20-50 day negative crossover. And as he said, this isn't a sell signal necessarily. We go into a neutral position because the 50 is so far above the 200-day EMA. So it's more of a soft sell, you could call it. You would want to be in cash or fully hedged as far as the signal is concerned. I can see his point. We've got a PMO that's now really fallen farther. We're losing the bottoms that we had previously. You can see the OBV is really hurting as well. The other thing that is of concern, and I pointed this out to Tom earlier, but this is in the IT and long-term trend models, what we're seeing on the sector scoreboards. Now, I don't know if you remember, but last week we had mostly buy signals for the intermediate term trend model on the various sectors. The only two buys now left are consumer discretionary and technology. And I think that is something that we can be concerned about, that we've lost all of these buy signals. Typically, and we used to have a scoreboard that had it had far more in here. It had the equal weights as well as the index ETFs, but we're not doing that mechanically. So this is kept manually. So we don't have all of them. But what I noted back in the day when I had those is, as soon as you start seeing the scoreboard flipping, or as I said, flipping out, and you start losing those buy signals and you start seeing the neutrals, that does tell you there's some serious problems in the market. And intermediate term to long term, we're looking at some big time problems. For me, the reason I'm not going to buy into we're in a bear market just yet is the long-term trend model signals are still mostly on buy signals. And the sell signals in the long term are in those defensive areas. So I'm not ready to concede that we're in a bear market and that we're going to see a drop below the February low. Right now, I think we're in correction mode. I think we will test those February lows. And I'll come back up here so you can look at it. I think we will test the February lows on the indexes, but I'm not looking for a breakdown past that. I think once we hit that level, I think the bargain hunters are going to come out. You'll have gotten mostly the execution of this double top. The downside target will have just about been reached. If we do lose that February low, then you can, I'll hop on that bear market bandwagon. I will. I don't mind doing that. But at this point, you know, we're on that 200-day EMA. Let's see what's going on as a live version of this chart. And as you can see, we're bouncing off that 200-day EMA. I'm already seeing the PMO wanting to decelerate a little bit just off of this bounce. So I'm holding off on going that negative as far as whether we're in a bear market or not. But let's start looking at some of our indicators. And they're not looking that great. I will tell you that right now. So with the climactic indicators, these are the indicators I use to look for, you know, what the slant or bias will be over the next day or two. And what I had noted on, I believe, Wednesday and Thursday when I wrote about it, but we got these very climactic readings, high readings as far as breadth. At the same time, we got a breakdown below the lower Bollinger Band on the VIX. And remember, I do switch and invert my scale for the VIX because I consider high readings in the oversold area when I'm looking at a climactic reading, when I'm looking at what's going to happen over the next day or two. And you can see typically after we get that drop below the lower Bollinger Band and see climactic readings in one direction or the other, you do get that quick bounce or that rally pop, as I like to call it. And I was looking for a rally pop today based on the fact we did have these climactic readings 2 days in a row on Thursday and Friday, and we're sitting here below the lower Bollinger Band. So we did get that pop today. I don't know if that's going to last at this point. I don't have high hopes. And the reason being, I'm looking at my short-term indicators, and they still look very bearish. The good news, I suppose, if you want to look at this chart and find good news, is that we are looking at some very oversold readings right now on the short-term the short-term indicators, the Swenlin trading oscillators. You know, we had this, negative divergence, which was already a concern, and it's played out at this point. So now I'm going to start watching and seeing what happens with these lows, if we're going to get rising bottoms off of these indicators, or are we going to drop below that? It looks like we're going to drop below that when you look at the STOV. So I think the short-term indicators are still leaning quite bearish. Intermediate term indicators, they were looking fairly bullish, but you know, we had them trending up, but you can already see that those rising bottoms trend lines on those indicators have been broken over the last 2 days, and I think that's not a good sign. And you can see that we can get we can see these readings go much lower. You know, we didn't get them to go that low on that February bottom there, but I would be watching closely to see if we're going to end up with readings below that previous bottom. And I think that's not going to bode well at all in the intermediate term. So right now I'm looking at the short term and intermediate term as being quite negative. Let's go ahead and I'm going to look at the big four, as I call them: dollar, gold, oil, and bonds. And, I have been bullish on the dollar probably, well, since January, February, I believe. Actually, yes, it would have been when we got this double bottom for sure. I've been waiting and waiting for the dollar to do something, and it has not. And in fact, it is now broken down below this rising trend channel. You can see the 5 is now crossed below the 20. So we have a completely negative configuration of our EMAs. And look at this rather ugly PMO. We're seeing it turn down below the 0 line. And at this point, I would expect to see a PMO sell signal at the end of the day. So the dollar, it's ready to have this breakout. I keep thinking we're going to see that breakout, but it looks like we're going to have to go down again and test these lows back from January and February before we can start anticipating and looking for a possible turn. But at this point, the dollar is looking pretty ugly. If you look at the weekly chart on it too, you can see, we hit this very important area of overhead resistance. We just keep failing there. We just can't get above that. Now we're heading down. We could, as I said, we could be looking at testing lows here at about $23 for UUP. Gold, I've been very bearish gold lately, and we got this amazing breakout. And I know a lot of this is probably due to the sentiment out there, honestly. When the market and the VIX rise and people start getting very nervous, you'll find a lot of, bullish setups in the metals. And so it's not surprising when there's some worry out there to see gold doing well. We got to bounce off of this area of support at about 1310. I keep waiting for the breakdown there. And now I have to switch gears for sure because I've got a PMO buy signal now. Look at the scooter, just went straight up through the roof. So now I'm going the other direction. I'm starting to look for overhead resistance. And I would see that at about that 1360, maybe even 1365 area. I'm looking for gold to go up there and test that level. We'll see what's going to happen here once we get that buy signal. So the one thing that I'm seeing here, though, that could be considered a bit of an issue is that, we've gotten these very deep discounts on the physical gold trust. And that tells me that there is a lot of bearishness out there still. And when you get these high readings to this degree, it can cause some issues. You can look back here and it preceded the downside move on gold previously. So it turned out okay here when we got those deep discounts, but I'm going to be watching to see what the what the follow through is on this particular one where we're getting those deep discounts. But a PMO buy signal, I think gold's looking pretty good. And quickly here, I know we're getting down to the end. Got to leave more time for myself at the end. Okay, so with the weekly chart, you can see we're hitting that very important overhead resistance right at about that 1360, 1370. Look at that nice PMO bounce, though, off its signal line, getting ready to move higher. Like I said, I've been down on gold, but I think it's time for me to switch gears here based on these indicators and the setups. USO is hit at some very important overhead resistance here at about that 1325 level. I like the PMO. It's heading nearly straight up. I think we're going to get that breakout. If you wanted, you could make a case for a possible, double bottom, a little bit more complex here if you want, and that would be a breakout at that neckline. I'm looking for higher prices on USO at this point. And if you look at the weekly chart, we've got that breakout on on the actual price of per barrel. I like to see that on that weekly chart. And although we've hit that area of resistance, I think there's certainly a lot of room to go higher up into that, honestly, $14 and $16 area with a nice PMO turning up. The only thing I'd be a little concerned about is it does look a little bit on the overbought side. And finally, TLT. And we looked at bonds, and I think I picked one as well for our Monday setups. Nice rising trend channel right now, strong PMO. It was decelerating below the zero line, but you can see now it's starting to accelerate. I didn't get that annotation in there. We are still below the zero line, but we are headed back up above it. So I'm looking for good things out of bonds at this point. And I think, again, that might be a part of the nervousness of the market. And so with that, here are the how I've set it up here. We've got climactic indicators and double tops that have executed. So all of this information I will have in the Market Watchers live blog. But overall, I think we're in correction mode. I'm not I don't believe we're in a bear market just yet. But I do tell you that the guru, my mentor, Carl Swenlin, has pretty much stated there in his last blog, I highly recommend you read, that we are in a bear market situation. So, all right. Weekly schedule. Tomorrow we've got everything stock charts. Wednesday we have Mark Young from Wall Street Sentiment Survey. Arthur Hill will be here Thursday. Market is closed Friday. Hand it back to you quickly, Tom, and let's sign it off.
Good. I do want to also mention no workshop this week, obviously, because there will be no Friday Market Watchers Live with the market closed. So that will return the following Friday. I want to thank everybody for being with us today. Please remember to complete that survey as you exit. We'd love to get your feedback to hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll see you back here on Tuesday. Happy trading.